Hello, ladies and gentlemen, and welcome to what we think are going to be two very crucial weeks ahead of us in the thinner month of July. We start this week's review, as always, with the bond market in the States. The 10-year note has done exactly as we thought. It's come off 4 basis points from just below 290 to 285. Uh, the This churn continues. It seems as though some people think that the Fed will stop hiking very soon and are bullish fixed income. Certainly, if we start now taking out these levels around 276, 275, we could easily come back all the way down into the 260s and certainly fill this gap, which is still around 266. That would not be surprising, but just to show you uh, the scenarios under which this can happen, it's really tied with equities rather than just the 10-year note. If we look at the 30-year note, and really if we look at the TLT, we actually see that this is now coming into very, very good resistance above around 123 to 124. Very good resistance. This is a 200-day moving average, which is going to turn over. So we really think that around 124 to 125 is a very good level to actually start buying some puts on TLT, unless naturally equities surprise. And this is mainly in the next 2 weeks we're going to see some very interesting things out of equities because they have entered optionality territory, and I will now explain why we think so. Just a quick look at the 5 and 10-year bunds and bobble. This is the bobble, and as you can see, it is just hugging the lower weekly Bollinger Band, just as we forecast a couple of weeks ago. It is just doing nothing. There is a possibility that the bobble, the level to look at, is minus 39 basis points. That's going to be a very, very important level. We don't think we get there next week, but could do in a couple of weeks' time. And if we look at the German Bund, it's again hugging the lower Bollinger Band, and the level there really is anywhere between 23 basis points and 28 basis points. So that 5 basis point range is going to be the level that we think we need to make a stand and try to see if yields can turn back up during the course of the summer. And this will naturally depend on what equities do over the course of the next few weeks, and we now turn attention to a very pivotal time in the equity markets. Well, last week we said that 2700 absolutely must hold on a weekly basis. It did just that. 27, basically 2740 odd and 2700 was your range. We've got the levels right. 2740 followed by 2700. If market trades through one, it'll trade the other. Well, look where we are. We are right on this very, very important trend line, which we tried to bust so many times and failed. That is why we say, this is one of the many reasons why we say that we are at a very, very important juncture. The other one, of course, is fundamental in nature, and from the 7th of July onwards, we have the tariffs coming into effect by Donald Trump, and we need to see what the market's response is, and we need to see what the other nations' response is to Trump's tariffs. If the response is mild, predictions are that we trade straight back up to 2800 over the course of next week. If it's bad, we could easily take out this trend line, and if that does happen, very bad things are going to happen to the market. And just to show you how much lower it could go, we will look now at this next chart. This is an enlarged chart of the monthly S&P. As you can see, it closed the month basically where it opened. It's done a doji, and we have these very, very important moving averages which have caught basically the market every single month during the worst times and not allowed it to close much lower than that. If we start breaking these moving averages, we could easily come back and catch this red moving average, which has a very important role insofar as it's caught the market at least once in every year. There hasn't been a single year that this market has not traded this moving average apart from 2017. In 2017 it never touched it. In every other year it has. And therefore there is a distinct possibility that the market here fails, comes through these moving averages, and then there's just air below it. All these lows will not hold it. It will come back all the way to a 0.382 retracement of the entire move up, which is 2467. 2467 has been a level that we've been looking for a long time. If you remember, when we made this candle, we thought we could get an extension down to 2467, but no, we didn't. And here we are, 1, 2, 3, 4. Well, this is the 5th month later. We are now ready to make that move or basically go straight up. We think we are now in optionality territory. We think next month we either trade very close to these to this Bollinger Band on the monthly, which is at 2860, or potentially we trade all the way down to 2466. You can see how tail risk is increasing, and to get confirmation of that, we need to have a look at the volatilities. Here is a chart of the VIX and our levels 1627 and 1950. We are now right on the cusp of a breakout in volatility. These moving averages are supportive, and everything is basically huddled here around 14 to 1430. So either the market will take out 1627 followed by 1950 and will go into the 25s and basically very quickly test these levels. It's binary. Either we do that or we crash through these and we probably make new lows and go down towards 10. That is why we say it's almost binary. One of the two outcomes will happen, and will happen probably by the end of the second week of July. As soon as the market gets a whiff of what, if we're going to have a trade war or not going to have a trade war, we are going to have a major move in volatility and in the equity markets. Just to show you, this is a weekly chart of the volatility. Just to show you that when the market gets its bit between its teeth, it always trades at least 43 in terms of volatility. You can see how big a move that is. This is what we had when in February. This is what we had in 2015 when we had that panic, going back to 2011, going back to 2010, and this is 2008 when the Lehman moment, we just went berserk and went actually to 90% volatility. If we exceed the 20% volatility, we will know that the move down in equities has started or is underway, and really we should not be surprised to see the market trade above 40% volatility for a few days. You can see how well this just rhymes after a few weeks. This is the kind of attempts it makes, and it really would not be surprising if the market starts breaking down to go above 40. Neither should we be surprised to see volatility slump down towards 10 and below. There is nothing in the RSIs which says that here, neutral as we are at 52, we could not make one of those two moves. Just as the market is at crucial levels, so are spreads. This is SOX, so semiconductors, which are basically drivers of tech, and the yen. You can see how well it's caught the entire move up, and here we are right on top of the 200-day moving average and the 50-day moving average. When this thing moves, it'll move so fast it'll make your head spin. It could come down to 164 very quickly. We're talking about 3 or 4 days. Or alternatively, if the market gets relaxed and happy, we are going to go straight back up towards the new highs. And this again is also saying that we are in a potential very volatile period. If we try to get some clues from the Nasdaq, well, the Nasdaq probably is slightly more bearish than bullish, but it's not, there's not a lot in it. This here is the most worrying sign. We are going to have a new high in the market and not a new high in the MACD. If it rolls over and turns down, it'll have a move all the way down to 6,400 without a doubt, and possibly take out the lows of February. This is on a weekly basis, but we think it's more likely than not to stop at this trend line for a bit before it comes back down through here. So an A, B, C like that, and it will actually stop at the eventually this will be a great buying level if we ever see it. But this is a very worrying sign for the Nasdaq, and that is why also we are quite happy to be out of our tech overweight position. We are very cautious here because there isn't very much potential. Even if we turn this chart to a monthly chart, we are not really getting all that much upside from the tech. So if you can see, I'll enlarge this for you. It's very rare that tech goes up and doesn't make and doesn't respect the Bollinger Band. Well, the Bollinger Band is very close to the highs of this monthly move. As you can see, Nasdaq closed with a green candle for the month of June, but the upside here is very limited. Therefore, what it's saying is that either we're going to have a huge outperformance from the SPY against the Nasdaq, or we're going to have the SPY and the Nasdaq break down and come towards the lows. That is what the monthly chart is saying as an alternative, which if you think about it, it actually makes sense. What is this saying? It's saying that in case there isn't a trade war, things like XLI should outperform, XLF should outperform, because the yield curve gets steeper as you get more growth. Therefore, you will have ES outperforming tech, simply because all the components which are large like XLI and XLF will be doing better than tech. It is amazing how we have very much the same picture actually in SPY TLT. As you can see, we are between the 50 and the 200-day moving average. We are basically crawling along this bottom. We try the upside, failed, come back. Chances are that this market will move in 2 or 3 days all the way down to this kind of level, this trend line support, and that is a move of close on to 10% in terms of what we will get from the swing between TLT and SPY. That is a move that actually tells us that we are potentially likely to have a break of the lows of the year, and that would indicate to us that we are going to have SPY below the lows of the year, therefore justifying our level of 2466. On the other hand, there will be acceleration as well to the upside, and we will go back to trading these kind of levels where we have failed so many times. I would definitely expect these levels to be retested. And this is a chart of XLK, so therefore tech, over XLF, the financials. Well, you can see where it is. It is almost certain to come crashing back down towards 240, which is over a 10% move. That is why you get such a huge outperformance in SPY if there is no trade war, and you get probably continued outperformance by NQ over SPY if there is one. But in any case, if there's a trade war, both the tech and the S&Ps are going to get killed. However, if there is no trade war, the trade is going to be to buy XLF and XLI, which should really outperform XLK by a lot. And just to show you, because this is going to be potentially very important, this is a chart of XLK, so technology, over XLI. Well, if you get the situation whereby XLI in the States starts outperforming, it could come all the way back to where it started the year, almost around the 200-day moving average at 88, which is going to be a very violent move. So you have the situation whereby the market is now saying that if there is a trade war, SPY gets killed, NQ probably slightly less, but if there is no trade war, actually the real beneficiary is going to be XLI over XLK. XLI over XLK could come back. We are at 95, it could come back to 90. Well, that is over 5%. 5-6% move, relative move, outperformance of XLI over XLF. And I'm always amazed how technicals and fundamentals at certain inflection points come together. Here we are right on top of the 16 times Blue Angel for the S&Ps. As you can see, where's the next support if it takes out the 16 times? It's right here, somewhere in the 25, in the very low 2500s, and it normally breaks it by a bit, and so really would not be surprising to see 2460 before the market stabilizes and sees what the next trade is. Therefore, this absolutely confirms either we now start going well above 2800, and as you saw, the monthly Bollinger Band is around 2850, 2860. It'll probably take 2 or 3 weeks to get there if we get the all clear, but on the downside it could be a very vicious and violent move all the way to 2500 and slightly lower. Well, everything has been said. We can't change anything in the bond market simply because we don't know what the outcome is. if the outcome is bearish, you can for equities, you can bet that there will be a wall of money flowing into both European and US fixed income. They will fly simply because it's a knee-jerk reaction. Now, this is very important here. Elevated tail risk is present. As I tweeted to you last week, we have very elevated tail risk, both on the left-hand side and on the right-hand side. So be very careful, stick to option positions, and do not cover too soon if the break is on the downside. It's going to go a hell of a long way unless some fundamental news comes out and the plunge protection team works, overtime. We just don't think they'll be able to catch you this time. On the upside, we know exactly what to do. We buy XLF and we buy XLI. We have to watch XLF next week, as we said. 2830 is the key level. We think it's going to fly through 2830. So if you can get on very good news, if you can get it below 2830, you will do very well. So if world trade picks up, so will XLF, and most importantly, so will XLI. So those two are the ones to buy if it looks like world trade is going to be just fine. Thank you. The VIX, as always, will indicate the path ahead, and I've given you the very important levels. Thank you very much indeed, and looking forward to a very volatile couple of weeks coming up. Thank you, and have a great weekend.